After another eventful year in Australia and overseas, when global share markets fluctuated and rebounded and a new president was elected in the US, when people across the world started to find relief in the rollout of COVID-19 vaccines, we maintained focus on you with a disciplined and diversified investment approach that targets strong, long-term returns on your savings. It's been a big year for all of us, and we're happy to have shared the growth with you. Welcome to Rest's End of Financial Year Investment Update for 2021.
Good evening, everyone, and welcome to Rest's End of Financial Year Investment Update for 2021. I'm Gemma Kyle, Group Executive of Risk and Governance at Rest, and I'll be your host for this evening. In the spirit of reconciliation, Rest acknowledges the traditional custodians of country throughout Australia and their connections to land, sea, and community. We pay our respect to their elders past and present and extend that respect to all Aboriginal and Torres Strait Islander peoples this evening. Thank you for joining us in what we hope will be an insightful look into Rest's investment performance, as well as the great initiatives that our fund has undertaken in the last financial year. This includes our efforts towards building a fair and sustainable super system for all Australians, especially for you, our members. Due to the ongoing lockdown in Sydney, we have pre-recorded tonight's presentation. For those of you who have sent your questions in advance, there is a Q&A session following tonight's presentations. Members of our team are also on hand to answer your questions online. If we don't get back to you tonight, we'll be posting your questions and answers on our website shortly. We always value the opportunity to speak to you about your investments and to share news on the great things that are happening at Rest. Tonight, we'll hear from our Chief Executive Officer, Vicki Doyle, and our Chief Investment Officer, Andrew Lill, who will give an update on the performance of your investments with Rest. Andrew will also make an important announcement about our 2050 net zero commitments and the positive changes these initiatives will make to the way we invest your super. To start this evening off, it's my pleasure to introduce our Chief Executive Officer, Vicki Doyle.
Good evening. I'm Vicki Doyle, the CEO of Rest. Thank you for joining us this evening for an update on the performance of your investments with Rest over the last financial year. This past year has been incredibly difficult for us all. Whether it's living through lockdowns, feeling financial pressure or stress, or having concerns for family and friends here and overseas, it has been and continues to be really challenging. But the story of the year has also been one of incredible recovery on investment markets, which is positive news for your super. During the financial year, markets rebounded from the lows of March 2020, returning to pre-COVID levels before going on to deliver substantial gains. Not only have the losses of last year been fully regained, but thanks to some strategic investing from our team, many of your investments have grown considerably. Tonight, I'll share with you some of the highlights of this past remarkable year, starting with the performance of your investments. I'll talk about the introduction of our new sustainable growth investment option, an important part of our approach to responsible investing, and also cover some of the great digital advice tools we have on offer and how these can help you achieve a better retirement outcome. I'll update you on the work we've done to deliver insurance claims decisions significantly faster than the industry standards, so you get financial help quickly when you need it the most. And I'll share some of the important government changes during the year that help you grow your super balance. But first, I'm delighted that over the financial year to 30 June 2021, Core Strategy achieved a competitive return of 17.43% for Rest Super and Rest Corporate members. For those of you with Rest Pension, our default balanced option saw investment returns of 15.19% for the financial year. Throughout this pandemic, we've remained grounded in our investment beliefs, which include maintaining an active investment approach, a well-diversified portfolio, and a long-term focus so your investments grow solidly over time. Our Chief Investment Officer, Andrew Lill, will share some more about the work of the investments team over the past year and what it means for your retirement savings. Our focus remains on working to help you achieve your best possible retirement outcome. While investment performance is a critical part of this, so too is being part of a super fund that is fair and sustainable for you and for all Australians. Recently, we launched our new brand campaign, which highlights how Rest aims to be the super fund that represents a fair go for all Australians. You may have seen this on billboards, online, and on TV. You've told us that low fees, strong long-term returns, effective and affordable financial advice, and a simple and easy member experience are most important. These are the focal points for our work and our approach across Rest, and our campaign outlines our commitment to you on these points. Having a super system that is fair and sustainable is also something we advocate for. Over the years, there have been some significant changes introduced by the federal government. One of the most important was the removal of the $450 per month income threshold for superannuation guarantee contributions. This is particularly welcome for those of you who work in more than one job or on a part-time or casual basis. Previously, you would only receive a superannuation contribution if you earned at least $450 per month. When this change comes into effect, more of you will earn superannuation for every dollar you earn. In the past few weeks, the superannuation guarantee has risen from 9.5% to 10% and is legislated to rise to 12% by 2025. We've strongly advocated for this increase for some time because it will lead to better retirement outcomes for you. Our team at Rest also believe in giving you greater investment choice about where your super is invested. With 15 investment options, you have a range of choices based on your attitude to risk and your life stage. These options include structured, active, and passive options. Our balanced indexed option won a Money Magazine Best of the Best award for Best Value Balanced Super Product 2021. This is the second consecutive year this option has won a Money Magazine award. In March this year, we also launched our new Sustainable Growth Investment option, which is one of the lowest fee ethical investment options available from a super fund. It was developed based on feedback from you on the importance of sustainable investing and your expectation that we invest in companies and assets that make a positive contribution to climate change and society. You also wanted us to exclude investing in companies involved in environmental damage, animal cruelty, and unethical labour practices. The introduction of this investment option is part of Rest's commitment to responsible investing. We continue to work to help you achieve your personal best retirement outcome in a world that is rapidly accelerating socially, environmentally, and economically. Our program of responsible investing is an important part of this. We believe that responsible investment adds value. It can protect against risk and open up new investment opportunities. This includes our commitment to 5 United Nations Sustainable Development Goals and our ambition to achieving a net zero carbon footprint for the fund by 2050. Our CIO, Andrew Lill, will cover some new announcements about this later on this evening. In addition to providing great returns and a wider choice of insurance options, we also look at ways to continuously improve our customer service experience for you. In the past year, we've seen more and more Rest members are using our simple digital advice tools and starting to take a real proactive interest in their super. These tools are part of a larger advice offering we provide and are there to help you understand more about your super and how to make good investment choices. This year, we also made some major updates to our highly rated Rest app, which we know is one of the most important ways we help you engage with your super. With improved designs showing your balance, your transactions history, and investment options. We are already in the process of planning our next big updates for the near future. The Rest app has a rating of 4.6 on the App Store, so I highly recommend you download it today. We've also introduced some incredible improvements in the average time taken to determine insurance claims by our insurer, TAL Life. Your income protection insurance claims are now determined more than 80% faster than the timeframes set out in industry standards. This means that, for example, a claim for income protection is determined in an average of 9 days compared to the industry standard of 60 days. We want our members to know that Rest and our insurers and administrators are there to support you through hard times and make the process as easy as possible for you, especially when you need it most. In closing, this has been a challenging year for all of us. With the rollout of vaccinations globally, we hope to see the pandemic subside and some level of normality return. As we look to the year ahead, we will continue to make further strides on our commitments to responsible investing, including climate change. We'll also continue to advocate for a system that is fair and reflects the wants and needs of all our members. And we're always looking to continue building on our digital advice tools and look forward to launching even better updates for our app in the months to come. I'd like to encourage you to keep learning more about your super and to reach out to the Rest team for any assistance or advice around your super or insurance. We're always keen to hear from you and to keep working towards helping you, our members, achieve your personal best retirement outcome. Thank you.
Thanks, Vicky. To your point, I'd like to reiterate the commitment that Rest has placed on achieving responsible investment objectives that our members can be proud of. Our team really took on board all the things that you said were important to you when it came to ethical investing, and we'd like to share with you our journey so far.
At Rest, we want to help our members grow their super and achieve their best possible retirement outcomes while contributing to a better, fairer and more sustainable future. Our members told us that it was important that their super is invested responsibly in assets that are proactively improving environmental, social and corporate governance matters. That's why Rest is dedicated to sustainability and responsible investing by building our approach over a number of years across our investment options. We've aligned to 5 UN Sustainable Development Goals. We've also joined the Investors Against Modern Slavery initiative, invested in globally renowned battery storage and electric vehicles companies, solar panel industry leaders, as well as revolutionary wind energy suppliers, all working towards our goal of a net zero carbon footprint for the fund by 2050. This year, Rest also introduced its first low-fee, socially responsible investment option, Sustainable Growth. Rest Sustainable Growth includes a diverse mix of assets that have been carefully chosen, excluding companies that are involved in or profit from things like environmental damage, unethical labour practices, and animal cruelty, but are also making positive contributions towards the environment, human rights, and good governance. Sustainable Growth invests in a wide range of responsible companies, including renewable energy, companies in the field of health and medicine, companies that make it possible to share and reuse goods, and the building and ownership of sustainable property. We want to help all of our members grow their super and achieve their best possible retirement outcomes while contributing to a better, fairer, and more sustainable future.
The financial future of our members is most important to us, and that means helping you achieve your personal best retirement outcome in a world where the impacts of climate change are minimised. Now I'd like to introduce you to Andrew Lill, our Chief Investment Officer, who will speak to you about Rest's investment strategy and the factors impacting your investment performance.
Thank you, Gemma, and thank you, Vicky. I'm Andrew Lill, Rest's Chief Investment Officer, and I'm delighted to share with you some of the great results that we've achieved for your superannuation investments over the past year. It's fair to say that this has been an extraordinary year for all of us, with the pandemic continuing to generate uncertainty and having a big impact on our daily lives. But there is good news. With a continued recovery in equity markets both here and overseas, proving the value of staying on course with your super investments. Tonight, I'll be covering the external factors that influenced both the Australian and global markets and the developments that led to this year's double-digit returns for the REST core strategy investment option and for many of our other investment options. I'll also talk about the active investment approaches we've taken in response to market conditions to maximize your long-term returns. This remains a critical part of our investment beliefs: active management and a well-diversified portfolio approach with a long-term focus. And we also employ passive techniques to keep your fees low. We will look at our international shares and private equity investments to explain to you what we look for and how these asset classes have contributed to this year's investment returns. And finally, I'll speak to several of our responsible investing accomplishments over the past year, including some important announcements about our commitments to achieving a net zero carbon footprint for the fund by 2050. To cut straight to the most anticipated part of the evening, I am delighted to say that REST delivered a very competitive return of 17.43% in the default core strategy to REST Super and REST Corporate members. For REST Pension members, our default balanced option, which is more defensive than core strategy, returned 15.19%. It's a remarkable turnaround in investment performance over the financial year. Not only have last year's losses been regained, but your investments are now well in front. REST's default core strategy has continued to deliver solid performance over the longer term, returning a positive 8.59% per annum since the fund's inception 33 years ago, and 8.41% per annum over the past 10 years to 30th of June 2021. These results are well above our performance objectives, meaning that your retirement savings grew at a much faster pace than cost of living increases. For REST Pension members, the default balanced option returned 7.88% per annum over the past 10 years to 30th of June 2021. This also exceeded its objective of inflation plus 2% over the medium term of a rolling 6-year period. Our passive indexed options also achieved solid returns. Our award-winning zero investment fee balanced indexed option achieved a return of 19.98%, while our Australian shares indexed option returned 26.05%, and our overseas shares indexed option returned 25.13% for the year. These passive options provide a low fee alternative for you, our members. So with 15 investment options, you have a choice of where to invest your super savings to best suit your risk profile and your life stage here at REST. To understand the factors that led to these results, it's important to reflect on the year that's been. And it certainly has been a year of generally rapid recovery in investment returns. Of course, it's no surprise that the pandemic, above all else, has been the major influence on global markets. Stocks experienced one of their fastest and steepest market sell-offs on record in March last year. The rebound in markets has been just as dramatic, with overseas stocks now up by more than 87% in the 15 months since the pandemic lows in March 2020, and up close to 26% above their pre-COVID peaks. Several factors were at play here, including global government stimulus injections and ultra-loose monetary policy from central banks. In addition, the rollout of vaccines globally has allowed for a greater movement of people with the easing of restrictions and a reopening of economies, which contributed to the market's strong recovery. The US presidential elections and civil rights movements early in the year also impacted global market sentiment. We expect uncertainty to continue, but the portfolio and the REST investments team are well positioned to manage risks and opportunities to grow your investments over the long term. In the previous financial year, using active asset allocation, we utilized the cash we had on hand to buy assets at cheaper prices when the market was at its lowest. This paid off for our equities portfolio in particular, by generating strong returns during the market rebound. During the pandemic, we added exposure to both the Australian and overseas shares asset classes, while at the same time reducing the proportion of assets invested in cash and property. Throughout the year, we appointed new equities investment managers and increased our exposure to share markets locally and globally. We also rationalized the number of investment managers to fully utilize our scale of assets and to keep fees low. The bottom line is, while the strong returns this financial year are gratifying, we remain focused on continuing to deliver competitive long-term returns. I'm delighted to say that your equity investments have delivered very strong returns over the financial year. Investing, in particular in international shares, gives you greater exposure to a large range of companies in markets that sometimes have better growth prospects than Australia. This helps us diversify the sources of risk and return in the portfolio, and we expect it to lead to higher and more stable returns for you. To gain exposure to international shares, we work with external fund managers with expertise in identifying the best investment opportunities in developed and emerging markets. When we select managers, we look for, 1, an investment capability that follows a well-defined philosophy with evidence to support their investment beliefs. 2, a robust and repeatable process. 3, a skilled and appropriately resourced team. And lastly, a track record of delivering excess returns compared to the market index. Over the year, we worked with some of the best managers across the globe to tap into new products and opportunities. The addition of US-based Wellington Global Stewards as investment managers is a great example of how we've been able to leverage our relationships with external managers to tap into new products. Sustainability has been a huge focal point for us, and many of you have told us that you value ethical investment options. The Global Stewards team at Wellington target companies with a sustained track record of strong financial returns and exemplary stewardship, which is a more holistic approach to ESG integration. Some of the companies where your money is invested include in the area of healthcare, Medtronic, and Boston Scientific Corporation. And in the area of financial companies, Charles Schwab Corporation. As well as overseas shares, we also invest in private equity. Private equity is buying into private companies that aren't listed on stock exchanges. As a part owner of such companies, your private equity investments gives you exposure to opportunities that are typically unavailable to individual investors. Privately held companies don't have the same pressure on share prices as publicly listed companies. This means they have a long-term view and are rewarded for taking those longer-term risks, which can translate to greater investment results for you. There are certain things we look for from our private equity investment managers. We look for exposures that are exclusive because they are unavailable in listed markets. We also work with investment managers that can deliver great returns in both strong and weak economic environments. And we work closely with managers that invest in companies that are aligned with our responsible investment approach and that are always improving their portfolio of companies, including ESG practices. We aim to access small, rapidly growing companies, particularly ones with innovative technology or disruptive business models that others can't access. We are quite opportunistic, and this has really paid off, particularly over the last year. In fact, these types of companies really improved their market share during the COVID downturn and beyond. One such asset we recently invested in is the Plastic Surgery Centre, which owns the Institute for Advanced Reconstruction. They focus on reconstructive plastic surgery in the US and use cutting-edge technology to help patients with debilitating conditions by providing life-altering reconstructive surgery that very few specialists are able to perform. All in all, our private equity portfolio is dynamic and invests in a number of companies that are unique in the way they operate or what they offer, as well as bringing innovative new systems and ways of thinking to their industries. As you may have noticed, responsible investment is a focus, and we apply this across all of our asset classes. Responsible investment adds value, supports risk-adjusted returns, and is a critical part of our overall investment approach to deliver strong returns for you, while still contributing towards a more sustainable future. For those of you who have a particular focus on what you are invested in, and environmental, social, and governance matters, we launched our Sustainable Growth Investment option in March of this year. This option has already seen tremendous uptake by our members, with approximately 39 million in funds under management as of July 2021. REST's Sustainable Growth option is one of the lowest fee, socially responsible investment options available in the market. It is geared towards growth assets and aims to deliver inflation plus 3.5% per annum over a period of 12 rolling years. As Vicky mentioned previously, you shared with us what socially responsible characteristics were most important to you, and your feedback played an integral part in the inclusion and exclusion of ESG criteria we applied in this option. Climate change has been an area of focus for our fund because we know how important the issue is for you, our members. REST recently joined the Net Zero Carbon Buildings Commitment alongside 142 other signatories worldwide. We've committed to net zero carbon emissions in operation within our direct property assets by 2030, which is an important step in achieving a net zero carbon footprint for the entire fund by 2050. In addition to other great achievements in this space, I'm very pleased to share our roadmap to achieving a net zero carbon footprint by 2050. REST has 6 key measures that will allow us to ensure the long-term sustainability of your investments and to contribute towards the goals of the Paris Agreement. Our analysis estimates that if the global community achieves the goals of the Paris Agreement, we expect our members to be better off at retirement. And if we don't, the current trajectory of climate change is expected to leave our members worse off at retirement. Our commitment to this goal is our contribution towards ensuring that you can achieve your personal best retirement outcome. These are the 6 key steps that our fund is adopting to achieve net zero by 2050. By 31 December 2021, we intend to divest from all listed companies that derive more than 10% of their revenue from thermal coal mining. This is unless the company has a credible net zero by 2050 plan or science-based targets. We will advocate for an economy-wide reduction of emissions of 45% by 2030 as compared to our 2005 levels, particularly in order to continue reducing the carbon intensity of our share portfolios year by year. We have an ambition to increase our investment in renewable energy and low carbon solution assets to $2 billion in total by 2025. We aim to have our directly owned property assets operating with net zero carbon emissions by 2030. By 2026, we have an ambition to allocate 1% of the portfolio to impact investments. These are investments that generate strong returns and also provide benefits to society and the environment. We will regularly conduct analysis and stress testing of our portfolio against a number of different climate change scenarios, including for a society where there are net zero carbon emissions by 2050. We believe our net zero roadmap will ensure the continued long-term growth of your retirement savings in a lower carbon economy. To finish up, I'd now like to look ahead to what trends and expectations we anticipate will influence markets and investment returns. Recent data suggests that the global recovery is progressing well. However, we've seen some roadblocks with the unequal access and distribution of vaccines globally and some outbreaks of new strains of COVID-19. Time will tell what impact the current outbreak in Sydney and across Australia has on the Australian economy. All these impacts could slow down the process of reopening the global economy. The strong rebound we've seen in some economies is also worth keeping an eye on, as this could create inflationary pressures that we weren't anticipating, including higher interest rates and their impact on global financial markets. This is because some of the growth prospects in the current global economy are supported by record low interest rates and those government stimulus packages, leading to potentially further turbulence in the market ahead. We are also mindful of the challenges of geopolitical changes across the globe and the impact of climate change on policy, economic outcomes, and asset prices. All these challenges underscore why we believe it's important to stay disciplined, well-diversified, and focused on the long term with realistic expectations for returns. Through this investment environment, we have remained and continue to remain focused on working with you to achieve your personal best retirement outcome.
Thank you, Andrew, for taking us through how Rest's investments are tracking and reminding us of the importance of staying focused on the long term, especially during times of market uncertainty. We'll spend the next half an hour answering some of the questions that have been submitted in advance of tonight's presentation. Members of our team are also on hand to answer questions you send us online. We'll try to get to as many of these as possible, but if you don't hear from us tonight, we'll be posting your questions and answers on our website shortly. Okay, our first question of the evening is one for Andrew and comes from member Jade on responsible investing. She asks, what are you currently investing in that is sustainable, and how will your investing continue to support sustainability? She has a follow-up question as well, Andrew. How will your sustainable investing impact the earth and the future for the better? And will your investing have any negative impact on the earth or the future?
Thank you, Gemma. And Jade, I appreciate the question. Certainly responsible investing and sustainable investing as part of that is absolutely critical to Rest's investment approach and to achieving our mission to give members their personal best retirement outcome. During the last 12 months, we've done a number of things. We have launched our sustainable investment option, of which the whole portfolio is invested in sustainable investments and excludes those that we consider to not be sustainable. For our core default strategy, we have committed to a 2050 net zero carbon portfolio. And we have a number of pathways and commitments and steps towards that 2050 net zero carbon area. One of the interesting areas is in renewable energy or low energy transition investments, of which today we have close to $800 million of our portfolio invested in renewable and just over $1 billion of our total portfolio invested in low energy transition investments. They're going to be critical towards achieving the economy-wide transition to a low carbon energy future. The other area that I think is really important is about advocating for lower carbon emissions, and we set targets for both our equities portfolio and the amount of our portfolio that can be invested in what's called sort of high fossil fuel investments. And by the end of this year, we will actually be excluding those securities from our universe. And lastly, we really believe strongly in impact investing. We think that impacting investing, investing in communities to do good in those communities can be both beneficial from a return outcome and for reducing risk across our portfolio. So all in all, we can have options that are uniquely sustainable. Within our default largest core strategy option, we have committed to a number of 2050 targets. And as part of the asset allocation approach, we very much consider the impact of climate change on those investments, and certainly are gearing our portfolio for those investments that can really positively result in climate change having a lower impact on us all in the future. Thanks again for the question.
Thanks, Andrew. I have another one for you. This next question comes from Danny, who asks, can the share markets keep going up in this pandemic environment?
Thanks again, Gemma. Danny, great question. It has certainly been an amazing last 12 months in terms of share markets and their double-digit and 20% plus returns. In answering your question, yes, they can. They can keep going up. I do very much think that if we look towards the next 5 to 10 years from now, the return environment is going to get harder. A lot of the benefits that share markets have had over the last 5 years have been because interest rates have fallen, inflation has been at historical lows, and many companies have been getting a traditionally very large amount of government support stimulus through many different measures. I think all of those are going to be changing the opposite direction over the next 5 to 10 years. I think interest rates are going to go higher from here. I think inflation is going to go higher. I think government support will not be at the same level it has been for the last 2 years. So in my expectations, that's going to be harder for share markets to keep producing the double-digit returns. And therefore, I would be starting to think very carefully about a diversified portfolio, not just share markets. But in the short term, anything can happen. And we think that for the moment, probably kind of the area that we're expecting most from our portfolio is the share markets, and particularly global and emerging market share markets. So short term, yes. Medium term, perhaps it's going to get harder.
Thanks, Andrew. The next question is from Sherry, and I'll direct this one to Vicky. How can I make sure I am contributing enough now to retire into the future?
Well, thanks, Sherry. That's a great question. And I'm glad you're focused on how you can build that out. In this forum, it's not an easy question to answer because actually it depends on your personal circumstances. But there is a really easy way for you to access the answer. You can go onto the REST website, and we have some online calculators that are easy to access. You can log on and seek some digital advice specifically to your circumstances, which is quick and easy. Or you can give us a call at REST Advice for no additional cost. You can talk to one of the team who'd be delighted to walk you through your circumstances and work out how you can save the most that you can.
Thanks, Vicky. No surprises, the majority of questions are going to be for Andrew, so I have another one for you, Andrew. This one comes from Carly, who asks, how can the indexed funds have zero fees? What's the catch? Yes, that's it.
Thank you, Carly. It's an interesting question, isn't it? Can investments have zero fees? Well, just sort of to slightly kind of give you certainty on that. The investment fees are zero, but the overall index funds do have administration fees that REST applies. So they're not exactly kind of zero fee options. There is no catch. Basically, for that, in return for those administration fees, you as a member do get the same return as markets. We call that passive investing. And the benefit is that REST, through being a large super fund with lots of what's called scale in asset management, can work with some of our very strong partners in investment management, in this case, Macquarie Investment Management, and we can deliver the same returns that the market produces for those low and zero investment fees. So across the world, the cost of passive investing, which is what effectively this is, has got much lower. And I'm very pleased to say that at REST, we can deliver those passive indexed market options at zero investment fees. So I hope you, for those of you that consider that to be a good deal and want to be focused on the lowest fee investment options, these are for you.
Thanks, Andrew. That's great. My next question is for Vicky, and it's from Ron. He asks, why are the fees higher compared to other similar funds like Australian Super?
Well, thanks, Ron, for the question. And firstly, at REST, we always strive and pride ourselves in keeping our fees really low. So, in fact, REST's administration fees are 32% lower than the industry average. And that doesn't matter whether you've got a balance of 5,000, 25,000, 500,000. That's where we aim to always keep our fees. And you may not know, but we also have a cap on our administration fees of $300 per annum. So no matter what your balance is, we will always try and keep our fees at that lowest quartile and more than a third cheaper than our relative peers.
I have a question on bonds from Daniel. He asks, bonds as an asset class have performed well in recent decades, benefiting from falling interest rates. Conservative investment strategies like Capital Stable hold a lot of bonds. With interest rates at all-time lows, what happens when rates finally start to rise? Would that be a big problem for funds that hold a lot of bonds like Capital Stable?
Daniel, I'm pleased you've asked that question. It has been a topic that we have been working through with our investment committee and also our investment advisor, because you're bang on. The Capital Stable option, which really, as it says on the label, tries to ensure that your savings are in a stable environment and not subject to too much volatility, has traditionally had a large allocation to bonds, which has done very well. But going forward, the big risk for bonds is if rates start to increase from their sort of all-time low today, and that results in a negative capital gain. There is still that income part of the return, but if you get negative capital gain, it could be that the overall option loses money, and that's not our intention. What are we doing about it? We're doing a number of things. We are increasing the amount of the portfolio that is invested in inflation-linked bonds. We think the big risk for bond prices is probably through inflation. And so if you replace what are called nominal bonds with inflation-linked bonds, then as inflation rises, then you get some form of insulation or buffering to the way that bonds can perform. We're also investing more of that Capital Stable option in our real assets, our property, infrastructure, agriculture assets that, again, in an inflationary environment that might cause bonds to fall, are actually going to be in assets that do well in that environment. Traditionally, agriculture, and it's linked to food, infrastructure, and it's linked to people paying tolls on bridges and roads that are inflation linked are going to be producing better income. And then property that tends to do well in an inflation environment. These are all assets that we are increasing the size in the portfolio and will help to buffer any impact of bonds falling, to make sure that overall option remains stable and a good source of sort of low volatility and income into the future.
Thanks, Andrew. So Philip now wants to ask the question, why are our investment returns consistently below the market leaders, e.g. Australian Super, Hostplus and many others?
Yeah, well, I think that there's two things to say there, and I'm pleased you're sort of comparing the returns of REST against some of the best performing funds in the market. Clearly, we have very high expectations for any member of REST and ensuring that the returns are competitive. Over the 10 years plus, and if you look at kind of the period since REST was formed in the early 1990s, then REST has been amongst the best performing funds in the industry, and we will compare very well against the funds that you've mentioned there. It has been true to say that the last 5 years have been weaker in terms of our competitive returns, but in terms of meeting member promises of inflation +3 or strong long-term returns, then REST has continued to deliver to those promises. But that said, we think we've got a few things to learn from the last 5 years. We're putting that into practice right now, and with a team that I've been able to recruit over the last 12 months to match our existing team, then I'm very confident that in the next 5 years, you will see our returns being very well compared against those other large funds that you mentioned. I think just sort of to finish, it's a tremendous testament to the superannuation industry in Australia that many of the funds have delivered tremendous sort of returns higher than expectations, being able to sort of to complete the promise of delivering great strong long-term returns to members. And sure, it's a competitive environment, and we need to make sure that we are amongst the best performing funds in that industry.
Thanks, Andrew. I couldn't agree more. I've got a question on responsible investment for you. It comes from Kit in Paddington, New South Wales. She asks, please advise what level of investment REST currently has in fossil fuels and coal, and what plan, if any, for divestment in these areas. REST is committed. What is REST committed to? What is your level of renewable investment?
Thank you, Kit. these are very topical questions, and I'm pleased to say I've got the answers ready to give back to you. So we define a investment in fossil fuels and coal as any company that derives over 10% of its revenues from thermal coal or fossil fuel. And I'm pleased to say that across our equity portfolio, which is over half of our core strategy, we have less than 0.5% of the portfolio invested in these companies. Now, while that's a very small amount, it does mean that REST members continue to be investing right now in those companies that are, in some cases, considered to be the biggest emitters of carbon and climate change. So we have recently, with the agreement of our board, agreed a new pathway commitment to our 2050 net zero carbon commitments. And by the end of this year, 31st December 2021, we will no longer hold our members' assets in those smaller number of companies that have over 10% of their revenues from thermal coal. There is a small exception to that. If that company has a credible, as defined by science, pathway to changing their business model so that in the future they will have none of their revenue derived from thermal coal, then they will be considered to be remaining and not excluded from the portfolio. But I'm happy to say that this is an important topic, and we've considered it thoughtfully and are now acting to ensure that any companies that do not have that credible plan will be excluded going forward. And of course, in the sustainable product that we launched in March this year, those companies are already excluded from the portfolio and therefore not receiving capital from REST members. You've also asked about the level of renewable investment. We have two measures of that. Right now, we have $800 million of our portfolio in what is termed renewable investments. That's generally wind energy. We also have over $1 billion of our portfolio, that's almost 2%, invested in low energy transition assets. And the combination of those two things means that we are well progressed towards our target by 2025 of having $2 billion of our portfolio invested in true renewable investment assets.
Our next question comes from Steve and is for Andrew. How will tensions between China and Australia affect my portfolio?
This is a really sort of, topical area, isn't it, Steve? And thanks for the question. I appreciate it. Personally, I see that there are always areas of geopolitical concern across the world. And because Australia is a global, is sort of very much linked to the global economy, and the REST portfolio is invested globally, those geopolitical concerns will always sort of be something that we are watching out for. It's the real reason why you stay sort of well diversified across assets and regions and countries and currencies. But that said, your question is very specific, and so I'll give it a specific answer. I do believe that for Australia, the most important thing is that China keeps demanding iron ore. There has been no sign of any change in that throughout the recent tensions. Maybe because China knows that iron ore is very important to its economy, and certainly Australia is aware of how important Chinese demand for our iron ore is for our economy. I think until we reach the point that any tensions mean that area of trade is impacted, then the overall portfolio returns may be quite diluted. But if we do get into that sort of area, then the Australian currency is likely to change, and also many of the large companies like BHP and Rio and Fortescue within the Australian equity portfolio could suffer. So that's what I'm watching out for.
The best thing about these evenings and when we have questions from members is it truly reflects the diverse nature of REST membership base and the diversity of questions and queries that we come across every day. This one is for Andrew, and it's from Deborah, who asks, has REST thought about investing in nuclear energy as France and others have invested? Windmills and solar will create excessive landfill in the very near future, as with electric cars. It will be worse than plastic in the environment.
Thank you, Deborah. Again, as Gemma said, I really appreciate the question because it's clear that our membership has different perspectives, and that's what we really enjoy with these sort of evenings. The important thing is that any change that we're making in our portfolio towards being more sustainable is a slow and steady change. It doesn't impact the target that we have to always deliver best financial returns for you as members. And in certain areas of the economy, the non-green investments are the areas that still can deliver the best financial returns. As supply of certain energy gets lower, then we certainly think that there are good medium-term returns in that area. And I, for one, don't consider that sustainable or renewable energy won't also have its impact on things, the broader economy, and we'll have to work through that in time as that gets a bigger part of our overall economy. So have we thought about investing in different sorts of energy? Absolutely, we do. And we have different parts of the portfolio that will consider perhaps commodities that will support nuclear energy. I think the benefit of the core strategy is that we do expect it to be a portfolio that all types of members invest in, and doesn't have only one view. But we do believe that the market will best price every opportunity, and there'll continue to be areas that we are investing in that are not consistent with a sustainable future. And while they deliver strong financial returns going forward, we will continue to think very carefully about that part of the portfolio.
John asks, hasn't COVID killed the office property market? Will Rest keep investing here? Thanks,
John. I give you two perspectives on this one. For much of this calendar year, 2021, I was very happily spending 3 or 4 days a week in the CBD of Sydney in our offices there, and I thought the Rest team was collaborating very, very well in the office. Obviously, right now, if you look at the Sydney CBD where I'm based, it's very quiet, and it looks like sort of this may have a kind of an impact. The reaction that we're going to be most focused on is that I do believe that most companies will want their employees to spend at least part of the week back in the office, but it's clear that the office environment could be different. I don't think that it will be a good use of people's time going forward to travel and commute to the office to spend all day sitting in front of a screen answering emails when they could perhaps possibly do that at home. And so what is going to be required from an office environment are those collaboration areas, those areas to basically get to know your colleagues and to ensure that you're kind of working towards an efficient kind of team environment. And so we think the highest quality office properties will always be in demand and actually will go up in value. And Rest is making sure that our portfolio, we're sorting through it asset by asset to ensure that where there are less than highest quality office properties, we're probably net sellers. We're willing to sort of to take a bid coming in at a decent price. But where we have the highest quality assets and where we have those in development right now, we're going to be very, very much holding on to those assets, and we believe they'll have a very, very strong future, both from tenancy and from financial returns.
Thanks, Andrew. This one I'm direct to Vicky, and it's come through from Rest member Lisa. Why doesn't Rest contact me when they can see my super guarantee has dropped, so my income protection cover will need to be changed? They've left me paying for higher cover than I can claim for years now.
Thanks, Lisa, for raising that concern. Firstly, I would say that across the Rest members, there's sort of 1.8 million of them. The working patterns and demographics are really different. And we have a lot of part-time casual members who also work for multiple employers at the same time. So that means in any given week, any one of those individuals' super guarantee contributions changes all the time. So it's quite difficult for us to see what is a normal pattern. What we do try to do with the design of the insurance is we design it for life stages. So depending on what age you are, we try and set it at the right level. So young people aren't paying for insurance that would cover major house debts. And then as you get older and you've got more responsibilities, we set the cover a little bit higher. We also set it at a relatively basic level. So because we don't always know everybody's working patterns, and you can always increase your insurance, but obviously you can also always decrease your insurance. So I think from your perspective, the practical answer I encourage you and everyone to do is to always know what insurance you have. And the easiest way to see it and quickest is on your app, or give us a call and someone can tell you what that is. And secondly, if your working conditions change at all, just give us a call and talk to the Rest Advice team. And for no additional cost, they'll work through with you what the best level of insurance is for your needs. And I would suggest that that's the best course of action for us to help you.
Thanks, Vicky. Okay, the following question comes from Brandon. I should note we probably don't have too much more time for questions, but the following question comes from Brandon and is directed towards Andrew. Why does Rest not have the option for members to invest in shares, ETFs and LICs directly, or Bitcoin? I am actually not aware of what those acronyms stand for, so you might have to help us out there, Andrew. Australian Super offers this as an option.
Thank you, Brandon. Great question. Gemma, I certainly will do that. ETFs are exchange-traded funds. LICs are listed investment companies that are listed on the ASX or other exchanges. Obviously, Bitcoin is a cryptocurrency. So these are all sort of very much tools of the trade. We believe that at Rest, all of our strategies, be it the single sector or the diversified options, they can all use these sorts of investments, be it direct shares, ETFs to gain exposure to markets, listed investment companies, or Bitcoin. And certainly Bitcoin is an area that we are considering in the future as a component part of our diversified options to try and sort of be a good store of value where there's concerns around other more traditional currencies like the US dollar and the Australian dollar. Our product team at Rest is always considering how it can best serve our members and considering different options away from the ones we have today. Today we have 15 different investment options. The key, of course, is will these help towards providing a better retirement outcome for our members? And if there's increasing demand for us to offer single sector or single tool investment options, I'm sure our product team will consider that. But just to summarize, these are all very much component parts of the investment products that we build for you as a member at Rest.
Thanks, Andrew. And I've got another one for you, Andrew. It's from member Paul. He asks, what impact will the divestment from coal companies you mentioned as part of the net zero 2050 targets have on my investment returns?
Thanks for the question. The answer to your question is it's impossible to tell. We do think that sustainable investments will have better returns at lower risk going forward, but in the short term, markets are volatile. The fact is that the coal companies that we are looking to divest from by the end of this year are only 0.5% of our combined equity portfolio. So even if they were to have an outsized return compared to the rest of our portfolio, the impact would be very small. So we do think that this is a move that we're making that has the right impact on our long-term financial returns and the right impact on the long-term effects for the community and the world that we live in. So that's why we're doing it.
We've come to the end of our financial year investment update for 2021. I'd like to thank you again for taking the time to attend this evening, and I hope you found the session valuable and informative. Thank you, stay safe, and have a nice evening.